Welcome back to the Commercial Real Estate Show. I'm Michael Bull. Our show title today, Office Market Forecast, Design, and Strategies. My guest is Walter Page. He's Director of Research with CoStar Group. And Walter, I'd like to ask you about the investment sales market, the capital markets. What are you seeing for volume? It would seem like with the improvements that we've seen in the fundamentals, the occupancy and the rates in the office market, that investors will be clamoring toward the office space.
Well, they have been. On a general perspective, sales volumes are high on a historical basis, but they are down about 20% from year earlier levels in the first half of 2016. So, clearly we're seeing some slowing in the capital flows. And we even saw a blowout of CMBS spreads earlier in the year. They since have come back. But things like fear of a recession, this Brexit thing, and other things like that is causing the market to become not as liquid as what it was in the past.
Okay. Well, so it's because of fear of the market. It's not because there's less maybe large Class A assets that are available to trade?
Well, in some cases that may be the case. Remember, we had such tremendous sales volumes over the past few years that all the good stuff has already traded. That may be, but for the most part, what I'm hearing from our clients is that when they put stuff to the market, the buyer pool is smaller. The number of buyers is smaller, so instead of 20 bids, they might get 10 or 5 bids. They might even have more situations where somebody would renegotiate the price after it's been agreed upon. Clearly we're seeing some signs that the market is slowing.
Yeah, that's interesting too, because if you look at the lack of yield and other investment opportunities around the world, real estate seems like a safe place to put your money. So what do you see for cap rates in the office market today?
So while the sales volumes are slowing, the cap rates are still very low. The cap rates as a whole are holding pretty steady. If we look at, for example, the Class A cap rates, they've basically been holding very steady in the 6.2 to 6.5 range, and really not that many trades are less than 6%. For the B's and C's, we're seeing the cap rates continuing to compress to some extent as we have a flight or a search for yield. Although even of late, those have been holding fairly steady. So for like a C property might be closer to a 7% cap rate.
Yeah, that's interesting. I've putting on the market a Class A building outside the Nashville submarket at a 7 cap. It's a Class A, and it seems like there's real good opportunity, and that they'd be a safe asset class for a lot of investors, especially what you said earlier with new supply starting to trend down a little bit, right?
Yeah, clearly we still have people wanting to invest in real estate. With this Brexit thing, we expect that there's going to actually be more foreign investment in the United States. We're tracking about 11% of the direct investment is right now coming from foreign investors, and if you add in the indirect fund investments, it's probably closer to 20% of the volume comes from the foreign investors. So, clearly we still think that there's going to be capital coming to real estate.
Yeah, it makes sense. With the changes in FIRPTA and now Brexit, it seems like U.S. is still going to be a safe haven. So what does that mean for cap rates moving forward?
So we got a couple things going on here. We have this flight to quality. So very low U.S. Treasury rates. We also have a increasing risk spread, and in the end, what our view is that we're going to basically have flat cap rates going forward. So what you get today is probably what you're going to have for the next few years.
And then do changes in interest rate impact that at all, or are you just thinking that they're going to stay so low that it's not going to really have much of an impact on cap rates for the next few years?
We think that the interest rates, we're not so certain that we're going to have an interest rate increase coming in the second half of this year. And even if we do, we just don't see that there's going to be that much push to change cap rates.
Okay. We're talking with Walter Page with CoStar about the office market. And Walter, where are some opportunities in the office sector for investors today?
So there's a couple things that we generally like. If you're a core investor, somebody who wants to be low risk, we favor strategies that focus on high occupancy locations. That can be in any particular market. There's always a place that tends to do better. So, for example, if you're in Dallas, Preston Center and Turtle Creek tend to have higher occupancy rates than other places. If you're in Los Angeles, West LA tends to have higher occupancy rates. And the reason why you want higher occupancy rates is with higher occupancy, you get better rent growth, you get better value gains and things like that.
So you can stomach that.
Now, if you're a value-add investor, we think now is a great time to fix up buildings. This flight to quality thing is very, very strong, and when a person renovates a building, they often get a 10 to 15% spike in rents following the completion of a renovation. So that's a great area for investment also.
And could those buildings be in cities like Boston and San Francisco, or maybe look at maybe some smaller markets?
Generally speaking, the more urban the market, the better the market performance is likely to be. They can be in the smaller markets, but in more infill type locations.
Okay, and what about these distress opportunities that some investors have thought we're going to have coming down the pike here with some of these 10-year maturities? Have you guys seen any of that? Do you expect any of those type of distressed office deals?
Very little distressed office deals that we have seen. I've heard of some, but very few. I think the capital markets has bailed them out. The only area that I think that there could be some distress is maybe coming in Houston, principally because of the weakness in that market due to the energy market.
Okay, so distressed office deals, it's like the unicorn, right? They're just not out there.
They're not, and most likely they're being priced like a regular deal anyways.
Yeah, that's true. Well, Walter Page, thanks for joining us today. We appreciate you being on the show.
Thank you.
Well, as usual, great information from Walter Page with the CoStar Group. And as Walter mentioned, maybe some opportunities in repositioning some of these office buildings. You've heard the rental rates increasing, occupancy increasing, but yet you do have some of these older buildings with opportunities. So next we're going to speak with someone who's going to give us some ideas on repositioning office buildings. So stay with us. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you by Bull Realty, Asset and Occupancy Solutions. Xceligent, building data everywhere. Valuate, easily share what-if analysis with colleagues online. And First Service Solutions, your CMBS borrower advocate. For more information on how these businesses may be of service to you, visit creshow.com.